With massive stimulus packages over the last year, resulting in over $4 trillion being pumped into the US money supply over the last 12 months, the concern over inflation and the debate over when that inflation will come has become one of the most heavily debated topics in all of finance since March of 2020. And while inflation directly affects the cost of goods and services, inflation also has a direct impact on real estate investors in all property types, affecting the cost to build new properties, the cost to own and operate real estate, and the cost to finance real estate deals as well. So in this video, with so much talk around inflation coming on the horizon, what we'll do is break down what this might mean for real estate investors if this does end up materializing, and some things that real estate investors can do right now to benefit from a hyperinflationary period in the future. So the technical definition of inflation is a general increase in prices and fall in the purchasing value of money, essentially meaning that in the US, inflation reduces the value of the dollar in relation to what you can buy with that dollar. And with trillions of dollars of stimulus funds being printed over the last 12 months, the increase in the money supply has introduced a very real threat of inflation numbers that we haven't seen since the late 70s and early 80s here in the US. And over the past year, the thousands of fragmented news articles released covering the various stimulus packages that have been passed have made it easy to lose the forest for the trees here, but a helpful way to put all of this into perspective and to see the aggregate impact of all the money being printed over the last 12 months is to take a look at the year-over-year changes to something called the M2 money supply. The M2 money supply is a figure tracked by economists that includes cash, checking deposits, savings deposits, and money market securities, essentially measuring how much money is in circulation at a given point in time. And even though we've known about these stimulus packages as they were happening, what happened to the M2 money supply over the last 12 months is shocking when you step back and take a look at the change. In February of 2020, the M2 money supply in the US was $15.5 trillion and had been growing gradually at a fairly steady clip since the turn of the century. But in 2020, the M2 money supply almost went vertical, and by February of 2021, the total M2 money supply figure had jumped all the way up to $19.7 trillion. This means that the money supply increased by 27.1% in just a 12-month period. And to put this into context, this is the highest year-over-year increase in this metric on record since this figure began being tracked in 1959, with the next highest year-over-year increase at just 13.8% occurring back in 1976. And with money being printed at this velocity, coupled with spending volume already back at 2019 levels, inflation concerns are starting to get very real because the price of in-demand goods and services can now be bid up even higher with the increased money in the system. And this bid up in pricing has trickle-down effects outside of just the price of food or gas or electricity. So if inflation does end up materializing over the next few years, and we go back to the days of mid-single digit or even double-digit yearly inflation, the question becomes what happens to real estate investors if that's the case, and how can real estate investors cover their downside if that does happen? Well, first and probably most impactful for real estate investors is that real estate can often serve as an inflation hedge directly due to the nature of commercial lease structures on both the income and the expense sides of the equation. From a revenue perspective, for multifamily investors, leases turn every 12 to 18 months in most cases, meaning that landlords can quickly adapt to increasing costs to own and operate a property by increasing renewal and new lease rents as inflation increases over time. And for retail, office, and industrial properties on longer-term leases, many of these agreements include annual base rent adjustments tied directly to the Consumer Price Index, or CPI. Even for leases that call for fixed percentage increases in base rent each year, these contracts often include fair market value base rent adjustments, either at certain points in the lease itself or at the time the tenant has the option to renew, which again can allow investors to keep up with any sort of inflation pressures during their ownership period. And on the expense side of the equation for retail, office, and industrial properties as well, one of the biggest inflation hedges in these types of properties is that tenants are often required to reimburse the landlord for their pro rata share of operating expenses at the property, which shields landlords even more from any major expense hikes that are a direct result of inflation. This means that if the cost of labor rises significantly for things like janitorial contracts, maintenance staff, or on site management teams, or material costs rise significantly, making it more costly to maintain and repair property on a regular basis, in commercial leases, these costs will often be passed on directly to the tenant and reimbursed to the landlord on a monthly or annual basis. And aside from the actual structure of the leases themselves, rising inflation also tips the scales in favor of real estate in another way through an increased imbalance of supply and demand fundamentals. Inflation leads to an increase in the cost of labor and materials, which is exactly what's needed to develop new properties and ultimately increase supply in the market. And when the price of labor and materials increase, either one of two things can happen. The first scenario is that the development pipeline will slow, leading to demand outpacing supply in many product types, increasing rents for existing properties in the process. And the second scenario is that builders continue to decide to go ahead with expensive construction costs and then to try to justify those costs with top of the market rents or sale prices on their new properties. We're already seeing scenario 2 play out today, with lumber prices jumping by an insane 67.2% between April of 2020 and February of 2021, and the average sales price for new homes in the US jumping from $360,000 in April of 2020 up to $416,000 in February of this year, a 16% increase for new product during that 10-month period. In a lot of different markets in the US, we already have a supply shortage for both rental and for sale housing, which has caused tremendous upward pressure on home values over the past several years and rents that have grown to such unaffordable levels that governments have actually had to step in to enact rent control measures in many US states and cities. In either scenario, the supply of affordable housing doesn't increase enough to keep up with demand in the market, which continues to create upward pressure on commercial and residential property rents and values as a result. Now, aside from rents and values increasing in an inflationary environment, a second and almost equally important impact for many real estate investors is that the weakening of the purchasing power of the dollar allows investors using fixed rate debt to benefit from disproportionate cash flow increases on their properties over time. The vast majority of real estate transactions are financed with debt, many of which lock in a fixed interest rate upon loan origination that won't change throughout the entire loan term, usually somewhere between about 5 to 10 years in most cases for commercial properties. This means that even if inflation hits and rents increase due to the factors that we just talked about, fixed rate loan payments can stay the same for sometimes a decade or more, meaning that an investor's monthly debt service payment will be the same 10 years from now as it is today, while operating income at the property is likely to have increased substantially during that same 10-year period. For example, let's take a look at a sample $15 million acquisition of a property acquired at a 5% cap rate, and we'll assume that property is acquired with a $10 million loan at a 3% interest rate amortizing over 30 years. Then let's assume we plan to hold the property for 10 years, and we'll also assume that inflation goes crazy and our net operating income, or NOI, increases by an average of 5% per year over the next 10 years. And in this scenario, our NOI will have grown by a total of 55.1% over that 10-year hold period, which is already a huge win for a property owner from a cash flow and value growth perspective. However, where this gets even more interesting is after taking those loan payments into account, with the cash flow after debt service increasing almost 170% during that same 10-year time frame, from just $244,000 in the first year of ownership to over $657,000 in year 10 of the hold period. Now, a big part of managing risk is managing debt levels, but this just goes to show that during inflationary times, if leverage is used correctly, real estate investors can significantly magnify returns by using debt on their properties and can end up winning from both a cash flow and value perspective. Overall, with the available money supply increasing by over 25% in the last year, and the availability of goods and services not keeping pace, I am a believer that we will likely see some form of increased inflation in the very near future. But for real estate investors who have already locked in long-term fixed rate debt and own properties with either short-term lease structures or long-term contractual rent increases that are tied directly to the consumer price index, I actually see an inflationary environment as an opportunity for real estate investors rather than a disadvantage. And if you're looking to get into the game now before inflation hits and want to learn how to run analyses like we ran in this video and how to build models to analyze and underwrite real estate deals you might have your eye on, as always, make sure to check out Breaking the CRE Academy, which includes courses on building acquisition and development models from scratch in Excel, courses on analyzing and valuing multifamily and commercial real estate properties, and a library of pre-built acquisition and development models so you can practice what you learn in the coursework in real time. And if you like this video and want to see more content like this on current events and the economy as a whole on this channel, make sure to hit the like button to let me know, and let me know in the comments what you see as the future of inflation and what that looks like going forward. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already, if you want to see more videos like this every week, and I'll see you in the next video.